Canada's oil patch was already having a tough run, from pipeline problems to turmoil in the international markets, and then a pandemic. It culminated last week with the price per barrel going not just to rock bottom, but below that. Joining us now from his home in Calgary, Alberta to explain, there's Max Fawcett, freelance writer and former editor of Alberta Oil Magazine. Max, how are you managing through all this?
Every day is, a new challenge, but happy to be here to talk to you.
Amen to that. Last week, the price of a barrel of oil went into what they call negative territory for the first time ever. Now, what does that exactly mean?
It means something that's never happened before in the history of oil markets, and oil markets have seen a lot of crazy things. What happened is we had two black swans hit the oil market at the same time, and one black swan is more than enough. We had a price war between Saudi Arabia and Russia, who are two of the largest producers in the global oil market. They were basically upset with each other, determined to squeeze each other out of certain markets, and that was bad news. And then the pandemic hit, and everyone was told to stay at home. We're not driving our cars, we're not going to work, we're not flying on vacations. And so you saw demand for oil fall, not just more than it ever has before, but by many, many multiples more than it ever has before. During the Great Recession in 2008, 2009, we saw demand drop by, I think, 1.5 to 2 million barrels a day. Right now, we're looking at 25 to 30 million barrels a day in the second quarter, which is just mind-blowing. And so what happened is the storage tanks around the world are filling up. There's just not room for more barrels of oil. So the market needs to send a signal to producers to say, stop producing, shut your wells in. We don't need this. We don't have space for it. But there's what's called a paper market for oil that sits on top of that. So, you and I can speculate on, do we think the price of oil is going to go up, or do we think the price of oil is going to go down? And in normal times, the paper market and what's called the physical market, they get along just fine. But what happened here is that you had a paper market where people suddenly realized that if they didn't sell their holdings of oil contracts, they were going to get delivered barrels of oil. They were literally going to have to take delivery of many thousands of barrels of oil. And if you're a speculator, you don't want a bunch of oil dropped on your front porch. And so you had this panic where all of these, what are called longs, people who are long oil prices, they thought they were going to go higher, had to sell, or they would take delivery of barrels of oil. And as we saw, some people were willing to pay $38 not to take delivery of a barrel of oil. So that's what happened in that market. And that might happen.
This goes to the expression that we've heard: you literally couldn't give it away.
Yeah, I mean, they would have been happy to take $0, but you had people saying, we'll take your oil, but you're going to need to pay us the cost of storing it, which, turns out it's, somewhere in the neighborhood of $38 a barrel. So, it was something that the smartest brains covering this sector, and believe me, I'm not even close to them, they didn't see this coming until it was right on top of them. And it's not clear that it won't happen again in the next month or two, because we're still at home, we're still not driving, and the tanks are full. There's nowhere to put it.
Have things changed since then?
So we've seen the market do the work that it's supposed to do. Producers, in the face of basically paying to sell their oil, have decided to shut in. So in Canada, we've seen many hundreds of thousands of barrels a day of shut-ins announced. We will see millions of barrels a day in the United States in the shale sector, where companies are just getting massacred right now, but they are shutting in. We're seeing shut-ins in Saudi Arabia. We're seeing shut-ins in Russia, Brazil, Mexico.
Shut-ins meaning what?
Sorry, shut-ins meaning basically you turn the taps off on a barrel of oil. And companies are reluctant to do this because it costs money to cap an oil well. It's not as simple as just turning a valve. And once you do that, you actually reduce the amount of oil you'll ever get out of that well in the future. So it's a decision that companies are extremely reticent to take. They will only do it in a situation of last resort. But here we are. This is the last resort.
So they're not going to stop drilling. For most of them, they're just going to keep going and presumably try to drill less. Is that an option?
The drilling is also stopped. So we've seen the rig count, which is the number of drilling rigs that are out in the field, collapse below where it was in 2016, which was the last sort of major price crash. More importantly, and I'm going to get a little sort of technical here, but what's called the frac spread, which is the number of crews that are out there hydraulically fracturing these wells in the shale sector, that is just plummeted. It's going to, it was a few hundred a few weeks ago, and it's now going to be in the double digits. So, as bad as it is for the companies and the workers at the companies that produce oil, the workers and the companies that get the oil out of the ground, the service companies, they're in very, very deep trouble right now.
And fracking is in such distress because why?
So that industry was built in large part on a lot of debt. Wall Street was very happy to lend them money to keep drilling, even though a lot of those companies didn't actually produce profitability. They didn't get more cash out of their operations than they spent running them. And the nature of shale, part of why it has grown so fast, is that the wells, they're very explosive when they come online. They produce a large amount of oil very quickly, but then it disappears very quickly. What are called decline rates, which is the amount that a well declines in production year over year. In the shale companies, it's as high as 70%. Whereas for a Canadian oil sands company, it's maybe 10%, right? So they're in very deep trouble because they have these wells where all of the production is coming online at a time when basically they have to give it away, that just destroys their economics. They're already indebted. It sounds like Wall Street is not going to ride to their rescue a second time. So there's this weird situation where, as bad as it looks right now for Canadian oil producers, and it is bad, it is painful, this could actually in the long term prove to be a good thing.
How do you figure?
Well, what was causing a lot of problems for Canadian producers was, partly it was we couldn't get our oil to market because we don't have enough pipeline capacity. That looks like it's starting to be resolved. We have the Trans Mountain pipeline in BC that is progressing. We have, the Keystone XL pipeline, which has hit another legal hurdle in the United States. But people I've talked to sound confident that it's going to progress. And Alberta Premier Jason Kenney invested a big schwack of money in ensuring that the proponent could proceed by guaranteeing their loans and investing a little bit in the pipeline. And then there's Line 3, which goes into Minnesota, and that one also looks like it's progressing. So that long-term problem looks like it might be resolving. The more optimistic thing, even more optimistic than that, is shale may never recover. So, for the longest time, shale was basically pushing Canadian oil out of its key market, which is the United States. It was competing a lot of our barrels away and making it hard for us to sell into the markets we want to sell into, because they just kept growing. It was phenomenal how fast shale grew. It was. The Saudis tried to flood the market and teach shale a lesson, and the Saudis had to give up because shale basically taught them a lesson. They went back a second time here earlier this year, and I think the lesson might stick this time. Wall Street, I think, has learned that they've lost so many billions of dollars investing in these companies. I think they've finally learned their lesson. And because the shale companies have had to stop drilling right now, they had to pull frac spreads out of the field. They're going to spend the next 2 or 3 years just catching up with their decline rates. It's going to take them, maybe 4 or 5 years to get back to where they were just in January. And I've heard people saying they may never get back to where they were then. So that opens up a lot of room in the market for Canadian producers who, we are higher cost in some respects, but it's easier for us to bring on production. You just go out into the oil sands and pull a little bit more out of what's already there. If we have the pipeline capacity, we can get it to market, and that's a good thing. So, if were I an investor, and this is certainly not investing advice, friends of mine can tell you should not take my advice on investing. But the Canadian companies look a lot stronger than the American ones right here. They've spent the last few years really tightening their belts, cutting costs, really getting lean, and they may be the strongest ones when we come out the other side of this. It's just a question of how long it takes to come out.
Let's do a little comparing and contrasting here. If you're fracking, the price of oil needs to be at what for it to make economic sense, versus if you're drilling in the oil sands, the price of oil needs to be at what for it to make economic sense?
So, the answer is it depends, which is a frustrating answer. There are different pockets of the shale play. Some are incredibly prolific, and therefore the break even is incredibly low. There's been a bit of fancy math that the shale sector has done in recent years where they've tried to argue that their break even is $20, $30 a barrel. And that's because they're excluding the costs of running the company, head offices, salaries, things like that. That's just the cost in the field to get it out and into a pipeline. So, I think you could probably set your watch to $50 a barrel for shale in terms of it being able to sort of be profitable. I think right now, maybe 60, 65 US WTI for them to grow, for them to, to really put money back to work.
West Texas Intermediate.
Yeah, West Texas Intermediate. Because, part of it is these companies are going to have PTSD. They're not going to forget what the last few months are like. And, I think if we see higher prices, they're likely to take that money and pay down debt, maybe pay shareholders a dividend. They're going to be more reluctant to just grow like they were in the past, because they know that there is this possibility lingering out there. Maybe not another virus, but maybe the Saudis and the Russians drop the hammer again on them. Who knows? So I think they will be a lot more cautious than they have been in the past. In Canada, there's some oil sands companies that can bring on new production at $25, $30 a barrel. The bigger companies, the strong ones like Cenovus, Suncor, Canadian Natural Resources, Imperial, their costs right now are pretty darn low. Certainly, they're not going to build another new oil sands facility. The ones that we saw in the mid 2010s, the big mega projects up in Fort McMurray, those are never happening again. That I don't care what the price of oil is, they will never build another one like that, because they've just gotten burned too many times. The recent ones they built in 2016, 2017, the break even on them is $90. And I don't care how optimistic you are. I don't think anyone out there is willing to project $90 barrel of oil for 20 years, which is sort of how long it takes for them to pay out and become profitable. Like that. That's the challenge with these big oil sands plants, is that once you get them up and running, they're great. They're pretty cheap. They're pretty efficient, but it takes upwards of 10 years just to earn back the capital you put in to build them. And with climate change becoming a more relevant concern every day, with carbon pricing, I think, growing in stringency, the people who provide the capital, and these are the smartest people in the room, they're not going to be willing to take those 10, 15, 20-year risks. They're going to want to keep their risks a lot shorter than that. So, the oil sands can grow, but they will grow modestly, and I don't think that's a bad thing. The go-go growth of the mid 2010s wasn't great for workers. It wasn't great for the community of Fort McMurray. It wasn't even great for the provincial treasury here. So,
or the Canadian dollar, for that matter.
Or the Canadian dollar. So, maybe slow and steady really does win the race.
You know what? I should take advantage of this opportunity and ask you to just explain the difference to us between four different kinds of product here. What we take out of the oil sands, shale, Saudi, and let's say Texas. What's the difference between all those four different types?
So the difference in oil is basically the sourness of it and the heaviness of it. So if you imagine oil on a sort of quadrant chart, it goes sweet to sour and it goes light to heavy. And based on those properties, you can get different things out of it. So oil on its own is not super useful. I mean, you can, I don't know, fill a bathtub with it and take a bath. I don't know. It's not useful, but when you put it into a refinery, they can turn it into things that are very useful. So gasoline, jet fuel, diesel, and a bunch of other petrochemicals that we use in plastics. the industry lobby does a very good job of putting these charts out that shows all the things that we use that come from oil, and they're right. It's everywhere, and we don't see it. So that happens at the refinery level. In terms of the differences, Saudi oil is very light and very sweet. It also costs them basically nothing to pull it out of the ground. It is almost the equivalent of sticking a straw in the sand and oil comes out. That means they are truly blessed in that aspect. And that's why, as much as we detest Saudi policy, we detest the way they run their government, they will be producing oil for a very, very long time to come because it is just so dirt cheap there. In Canada, ours, we do have, we have lighter oil in different pockets, but the bulk of our oil is oil sands, bitumen, and it is that very heavy tarry. They don't like to use the word tar sands, but that is what they used to call it. Sticky stuff, and it takes a lot of work to get it separated from the sand. I mean, it is kind of a miracle technologically that we've figured out a way to do it, and I think the industry deserves full credit for the innovation there. I mean, like I said, Saudi Arabia, you just stick a drill in the ground and it comes out and you're rich. In Canada, we've had to do this amazing science to separate the oil from the sand and make it usable. There is this sort of interesting narrative, especially among environmentalists, that Canadian oil is dirty and it's low value, and that's actually not true. Canadian oil is quite valuable because heavy oil produces things like diesel and jet fuel in higher quantities, and that's what the world wants right now. It's what well, not right now, but in normal times, that's what it needs. The light oil that comes out of shale plays is so light that it is almost it almost isn't oil. It is so light that it is almost sort of a different product, which is called condensate, which we use to lubricate the oil sands as they move through the pipelines.
Good. Great explanation. We've got just a few minutes left here, Max, and I wanted to raise one more thing with you, which is, pipelines up until this pandemic have really dominated the news cycle as it relates to the resources industries out west. And if it looks like this pandemic is going to be around for a while, and it does, and if it looks like the economics of the oil and gas sector are going to be what they are now for a while, and it does, why does this still make any sense to build pipelines today?
It's a bet on the future and the prospect of oil prices returning to more normal levels. I mean, I'm definitely in the school of thought, because this is a school that has had many lessons where the lower the price of oil goes, the higher it goes down the road. The cure to low oil prices is low oil prices, and we have never seen prices this low. So I do think, anyone who's writing off the oil and gas industry, who's saying, "Oh, well, this is the end of it," I do think we could see $100 per barrel of oil by 2023, 2024, and it could last for a couple years there. So
well, that means there's a lot of companies that have got to survive until then, and that's no sure bet.
No, I do think that the Canadian companies, especially the bigger ones, they'll be okay. The federal government is going to help them where they need help. They have better balance sheets than almost any company in Texas. So I think they'll be okay. And the pipeline is a bet on, oil being relevant until 2040, give or take. And I think that's a good bet. The other thing is that pipelines, one of the nice things is you can put different things in them. So, there's this growing excitement around hydrogen as a fuel, not only because it's zero carbon, but because it can store wind and solar energy. And if Alberta decided to build out its hydrogen sector, we could ship hydrogen through that pipeline and send it to markets in Asia. And we could continue getting value out of it for 60, 80, 100 years to come. So, we don't need to look at pipelines as being strictly vessels for oil. They're vessels for product. And there are other products in the future that we can and should be developing, and can and eventually will ship through those pipelines.
Can you, just in our last minute here, forgive this upper Canadian view of Western Canada, which I'm not saying I believe, but it's out there. And that is this notion that it looks from here that Alberta, goes through these boom-bust cycles in the oil and gas sector, and swears it's going to diversify, and yet seems to double down every time things get fantastic. From your perspective, does that ring true?
Oh, it rings painfully true. It rings very true for a lot of Albertans. It is a frustration that a lot of people here feel that we keep getting these opportunities to save for the future, to diversify, to build a more resilient economy, and we keep going back to the same old, same old. So I understand the frustration that people in Eastern Canada feel when they look at Alberta and hear that it's saying, please help us, when it seems like Alberta keeps making the same mistake. What I would say is that Alberta has been, not deliberately or intentionally, but effectively one of the largest contributors to Confederation over the last 3 decades. And I am not sympathetic to arguments that we are owed money or we are owed support. But I think in the spirit of the Canadian family, I think we're owed solidarity. So, I would like to see people in the rest of the country support those efforts at diversification, support investments in new opportunities out here, and maybe, cut us a little slack and understand that there are people here who feel the same frustrations that they do.
Understood. Max Fawcett, it's really good of you to join us on TVO tonight. Thanks so much.
Thanks for having me.
The Agenda with Steve Paikin is brought to you by the Chartered Professional Accountants of Ontario. CPA Ontario is a regulator, an educator, a thought leader, and an advocate. We protect the public. We advance our profession. We guide our CPAs. We are CPA Ontario. And by viewers like you. Thank you.